Dear students, so welcome you to the exam focus revision session on AAT2 Advanced Financial Accounting and Costing. Today, in this session, we are going to discuss how to tackle a partnership question. So, this entire session will be based on accounting for partnerships, which will carry 10 to 15 marks at your examination. So, let me share my screen. While sharing my screen, let me thank AAT Sri Lanka for having me in this session to conduct on accounting for partnerships. Okay, let me share my screen. Fine. Hope this is visible to you all. As you can see, today, within these 2 to 3 hours, we are going to discuss accounting for partnerships. The session plan is like this. We will have 18 questions to refresh theory. That means, my dear students, this entire, what I can say, the topic or the entire lesson, I will be driving you through 18 questions. So almost all the theory areas will be touched using these 18 theory questions. And then we will do some calculations to understand the theory, as well as we will do past papers to get familiarized how the examiner is going to test this. So this is the content for today's session. Now, let me start like this. You have learned accounting for sole proprietorships from your, I can say, from your O-levels. And in AD1 also, you have prepared financial statements for a sole proprietorship. But now, when it comes to AAT level 2, you need to prepare financial statements for a partnership. Usually, a partnership is when there are more than 2 people get together to do a business activity. In a sole proprietorship, there was only one owner. That owner was conducting the business. But in a partnership, what happens is more than one person or more than one people are engaged in business activities. They get together and they do a business. That is called a partnership. I guess you know. So let's start with the first question. So what is a partnership, my dear students? As I mentioned to you, partnership is a relationship between people. People get together and carry a business with a common view of profit. So all the partners are having the view of generating a profit from that business. Therefore, a partnership is a relationship, my dear students. So when there are more than one party involved here, when there are more than one party involved, always there is a relationship. So this all people are having one common motive, that is what? To generate a profit. To generate a profit. So there are main 4 features to have in a business if that business is going to become a partnership. Now, at the examination, that question can be asked. What are the features to become a partnership? If these 4 features are not there, not present, then that business will not become a partnership. Okay. Now, I have highlighted the keyword. So you also need to get an idea on that. Okay. So what are the features? 4 things. There should be a view of profit. Even the partnership ordinance define the people get together to do a business with a view of profit. Therefore, the profit should be a must. And there should be a business. There should be a business. Without a business, just an agreement, just getting into an agreement will not work. There should be a business activity. Okay, there should be a business activity. And then there should be persons. As I told you, this is a relationship. Partnership is a relationship between persons. Therefore, there need to have persons. And then there should be a common relationship. So this definition itself says these four features. What are the four features? Profit, business, persons, and the relationship. So to become a partnership, there should be at least two. There should be at least two people or two persons. Done. Now we know what's a partnership and what are the features to have in a partnership. Then, same like a sole proprietorship, there are some characteristics. There are some things that we can see in a partnership. Okay. So this can be also a question for an MCQ, I guess. Okay. So what are the characteristics of a partnership? Now, when it comes to a partnership, the same like a sole proprietorship, it has an unlimited liability. That means the partner's liability is not limited to the capital that they have introduced. Not limited to the capital that they have introduced. That means in case of a winding up, the partner should have to bear all the liabilities. Unlimited liability. And there are two or more partners. Yes, I told you at least two partners should be there. And no legal personality. Partnership is not considered as a person in front of the law. In front of the law. And availability of an agreement. Yes, when there are two or more parties, there should be a mutual arrangement, mutual agreement. If there is no an agreement, then it is hard to do a business. So in a partnership, we can see an availability of an agreement. Then when compared to a sole proprietorship, there is only one owner, but in a partnership, there are many owners, many partners. So we can raise more capital. In a sole proprietorship, only one person funding, but here more. That means we can fund more. We can fund more. Not only that, we can add various expertise. Why? Now, if I am an expert in financial accounting, okay, if I'm an expert in financial accounting, I can add another person who is an expert in taxation. I can add another person who is expert in management accounting or business advisory. Then I can form a partnership. So my partnership will have various expertise. But in case if I am doing a sole tradership, what I have? I know only financial accounting, then I will be based on financial accounting. Okay, then I will be based on financial accounting. Clear? I hope now these three aspects are clear with you. Then, what are the laws relating to the partnership? Now, for any business in Sri Lanka, laws are governing those businesses. Okay, laws are governing. So when it comes to a partnership, for a partnership also, there are a set of laws. What are those? The key or the main governing rule is the Partnership Ordinance 1890. Okay, this is the main governing rule. This main governing rule even we require for the accounting perspective also. We will learn it in a while. Okay. Then Companies Act number 7 of 2007. Companies Act number 7 of 2007, my dears. So for what purpose this Companies Act number 7 of 2007 is required? In a partnership, we say at least two partners should be there. That at least two partnership parties mentioned in the Partnership Ordinance. But Companies Act says the maximum number of partners in a partnership shall be limited to 20. So this says the maximum limit. This sets the maximum limit as 20. But my dear students, keep a note that this maximum limit is not applicable to a partnership in a profession. That means if the partnership is for chartered accountants, If the partnership is for lawyers, if the partnership is for engineers, then this maximum limit 20 is not applicable. That is an exception. That is an exception. Now, when you are listening to this, I will be continually speaking. You need to pause them and make notes. Okay. Then the Fraud Prevention Act, the Fraud Prevention Ordinance, 1840. This Fraud Prevention Ordinance says that if the initial capital is more than 1,000 rupees, this 1,000 was determined in 1840, okay? Not yet updated. So if the initial capital is more than 1,000 rupees, then there should be a written agreement. Then the Business Names Registration Act, number 7 of 1987, we require that for what purpose? If the partners are doing their business in the name of the partners, that means the business name is the name of all the partners, then that name should not be registered. But in case if the business is doing or business is conducted using a separate name, irrespective of the names of the partners, then that name should be registered. So now, in case ABC partners are conducting a business, then they should name ABC partners. If so, no need to register. But in case if the ABC partners are doing the business as handicraft partnership, then they should register the name. For that purpose, this Business Name Registration Act number 7 of 1987 is required. So now we know all the 4 laws relating to partnerships. Okay. Now, after learning these laws and regulations, let's check how the partnership agreement is formed. Now, I told you to become a partnership, there should be an agreement. Okay. So, when it comes to an agreement, you have learned the contract law, I guess. In contract law, we learn that the an agreement or a contract can be made either in writing, okay, we can write it, or verbally, we can mutually agree to words, and or else impliedly. By implication, now I am doing a business, other person is coming and helping me on that. They are not directly saying that I am a partner, but they are coming and helping. In that situation, it is impliedly showing that she or he is interested in continuing the business with me. So that is impliedly. So there are 3 ways that a partnership agreement can be formed. One is in writing, verbally, and impliedly. Either verbally, in writing, or any means, if we enter into a partnership agreement, the contents of that partnership agreement shall be these things. So that agreement, most of the time, these content can be clearly identified in agreement which is in writing. If this agreement is in writing or in written, then only we can directly identify those. If we have verbally agreed, how can we see this? We can't see it unless if we have recorded that. Okay. So my dear students, if the partnership agreement is in writing only, we can directly identify these things. So we can see the name of the partnership in the agreement, then name and address of the partners, who are the partners, then what is the main business activity and where the business is taken place, where is the office or where is our showrooms, okay, and the initial capital funded by each partner, okay, and how to share the profit. That's the most riskiest thing in a partnership, no? Now, if you are doing the business your own, if you are the only person, if you are the sole proprietor of that business, the entire capital will be funded by you and all the benefits, all the profits will be taken by you. In Sinhala, we say, gediya pitin ganna. Okay. But when it comes to a partnership, if few people contributed to the capital, then we have to split. We have to share the profit among them. So how to share the profit? What is the profit sharing ratio? Like these things. Okay. whether we are sharing the profit equally. That one. Then, interest on capital or any remuneration to the partners. Now, partners are funding or partners are giving capital, money to the business. Okay, so if those money was invested in a deposit in a bank account, then that partner would have get an interest. To compensate that, okay, to compensate that, we are usually giving interest on capital. Mainly in other means that if the capital or the ratio that capital contributed. Now, when there are 3 persons, if one person have contributed 100, then other one 200, other one 300. But if we are sharing profits equally, then there is a mismatch. If the profit sharing ratio and the contribution to capital ratio is not in line, then always for the partners who have contributed to a higher amount of capital will get a lesser profit, Their capital will not be compensated. In that situation, we give this interest on capital. Okay, usually in simple terms, you can keep in your mind when the profit sharing ratio is not equal to the what? The contribution to capital ratio. Okay, then how to admit a new partner? So when admitting a new partner, do we need to get all the consent or do we need to get the consent of all people? Okay, all people. Great. Now let's move on to our next part. So up to now, we have discussed 6 questions. So through these 6 questions, you have learned many important aspects. So this summary will help you to tackle the exam questions. Okay, now we are moving to the Partnerships Ordinance 1890. I told you under the laws relating to a partnership, the Partnership Ordinance is the main key, okay, is the main key law which relating to governing the partnerships. So, when it comes to this Partnerships Ordinance, main 2 sections or main 2 articles of that Partnerships Ordinance will guide us, will give some guidelines for accounting. Now here, our focus is not law, our focus is not management. Here we are focusing on accounting perspective. Now, when it comes to the accounting perspective, we need to check what are the governing sections in the Partnerships Ordinance to govern accounting of a partnership. So there are 3 actually, but for your syllabus, they have mentioned 2. That 2 is pretty much enough. One is section 24. This is the key section. This is the key section. And continuously testing. Mark that. Continuously testing. Continuously testing. And then the section 42. Section 42. Okay. So 2 sections, section 24 and section 42. Don't mix up these things. Most of the students mix up these 2. Don't mix up. Section 24 is the key. So keep in your mind, it is the key, 24. The lowest one is the most important one. The lowest value is the most important value. Sometimes the 0 is the most important value. Am I correct? So that's how it works, Lama. First of all, let's look at section 42. Section 42. What is this? Let me explain it and then I will show you the included thing. Now, assume there are 3 partners in the partnership, A, B, and C. These 3 partners are doing a partnership business. Now, on one fine day, C says that C wants to retire from this partnership. C wants to get out from this partnership. When C wants to get out from this partnership, what we have to do? That C has contributed to the capital of this company, or not the company, capital of this partnership. And he might have owned or he might have earned the profits which are retained in the partnership, which are not yet paid in cash. So simply saying, C has contributed to the equity of the partnership. Keep like that in your mind. C has contributed to the equity of that partnership. When a partnership is going to change, that means when one partner is going to retire from the partnership, okay, the partnership should pay the equity of that retiring partner. Okay, we need to give the cash which is equivalent to the equity at the retiring date. We need to give in cash. Now, in case if the partnership do not have sufficient money, okay, in case if the partnership do not have sufficient money to pay the equity, in that situation, okay, in that situation, that unpaid part, okay, let's say 1,000 is the equity need to be paid, but we had only 600 to pay in cash. Okay, we say, okay, we will pay 600 by now, then we will pay the balance 400 in near future. In such situation, this is the total equity that need to be paid to the retiring partner. 600 is the payment. 600 is the payment. Then this 400 is overdue. This is overdue or else payable. Payable. Now, in such situation, section 42 say we need to transfer this 400 into a loan account. Okay, that means we need to consider it as a loan given by that person. Once he retires, he is not a partner anymore. No? Therefore, we need to consider it as a loan given to the partnership, and then need to pay a maximum of 5% interest per annum. Maximum of 5% interest per annum. Okay, maximum 5% interest per annum. That's how section 42 says. But my dear students, in case if we have mentioned a separate term for this in our partnership agreement, then we can go ahead with the partnership agreement. Always keep in your mind, okay, our first priority is for the partnership agreement. First priority should be given to the partnership agreement. If the partnership agreement says for such unpaid equity of a retired partner will be benefited by 10% interest per annum, then the partnership can pay 10% interest. Why? Because we are honoring the agreement first. So our first priority, first we need to look at the partnership agreement. Then if the partnership agreement is silent, okay, if the partnership agreement is silent, or if the partnership agreement is not having any provision relating to this, okay, partnership agreement is not having provisions relating to this, okay, then we need to go ahead with sections of partnership ordinance. So I guess you are very clear now. First priority we need to give to the agreement, then we are moving to the sections if the agreement do not contain provisions for that. Therefore, let me erase this. So let's see what section 42 say. Okay, so section 42 say when a partner retires, the unpaid interest of that partner, that means the unpaid equity. Here interest means not the polyer, okay. Here unpaid interest means the unpaid equity. Unpaid equity. This unpaid equity of that partner is entitled to a maximum of 5% interest per annum. But keep in your mind, in case if the partnership agreement says otherwise, then we need to give priority to the partnership agreement. Okay. Now we are moving to section 24. So usually these both the sections comes into play when the partnership agreement is not there, or if the partnership agreement is silent on the provisions. Okay, if the partnership agreement is silent on the provision. Silent on the provision means partnership agreement not contain provisions relating to these areas. Okay. So let's see what are the contents of section 24. First one, partners are entitled to introduce equal capital and should share profit or loss equally. That means partners need to introduce capital equally. If there are three partners, all the three partners need to be contributed to the capital like this. 100, 100, 100, not 1000, 100, 100, 100. Then when sharing the profit also, okay, when sharing the profit also, the profit also need to be shared equally. So 5, 5, 5. That's what the section 24 say. Now, if there is a clause or if there is any other agreement or any other term in the partnership agreement, then the partners can give the priority to the partnership agreement. No issue with that. No issue with that. Okay, great. Then done. Then no entitlement for interest in capital. Okay. Partnership agreements, the section 24 say the partners are not entitled to get, okay, partners are not entitled to get any interest, okay, not get any interest for the capital that they contribute. Now, I told you in the partnership agreement, there can be a clause, okay, for interest on capital, no? Interest on capital. But section 24 say no entitlement. We cannot, the partnership shall not pay interest on the capital. Okay, shall not pay interest on the capital. But if a loan is given by the partner, now I will learn or else I will teach you how the partners can contribute to a business in various ways and in two capacities. Then you will understand this part. So in case if the partner has given a loan, that is not the capital introduced, that is a separate loan. If the partner has given a loan to that organization, then a maximum of 5% interest per annum, a maximum of 5% interest per annum can be paid. Okay, but here also same. If the partnership agreement say you need to pay 10% interest per annum for a loan provided by a partner, then we need to prioritize the partnership agreement. So always keep in your mind, first priority should be given to the partnership agreement. Then only we go for these two sections. Then partners are entitled to engage in management. All the partners have the equal right to engage in the management, but no remuneration, no salary for engaging in the management. Okay, they can engage in the management, but no any remuneration for that. Not entitled for any remuneration. Okay, no entitlement to the remuneration. Clear. Then all partners shall agree to admit a new partner. All partners shall agree to admit a new partner. Now here already we had A and B. Okay, already we had A and B. Now another partner name in C wants to enter into this partnership. If that partner to be entered, both A and B need to agree to take him, okay, to hire him to the partnership. If at least one person is not agreeing with that, at that time, such person cannot be taken as a partner to the partnership. Okay, so all partners shall agree to admit a new partner. Then every partner has right to examine documents and records. Yes, every partner has contributed to the capital. No? So every partner has the right to see the accounting records and any other records of the partnership. So here I have mentioned 5 key things. Okay, there are some more also, but these key things will be help you to tackle the exam questions. Okay, so always keep in your mind when you are learning this section 24 and section 42, first priority should be given to the agreement. If the agreement say, then we need to go like that. If even in the question, when the terms of the partnership agreement is mentioned, okay, something relating to this mentioned 4 or else 5 things are not mentioned in the partnership agreement, then we need to think, partnership agreement do not say anything about this. For example, let's say in the partnership agreement, they have not mentioned about the interest on capital. No any clause relating to the interest on capital. Okay. Then we are thinking, the partnership agreement is silent. Partnership agreement is silent regard to the interest on capital. So let's pay 5%. Can you do that? Can you do that? Can you pay 5%? No, you can't. Why? When the partnership agreement is silent, then you need to think, or the things need to come into your mind actually. We are not going to pay. Why? Section 24 says, don't pay interest on capital. Okay, they say don't pay interest on capital. Then you buy interest. So those things need to be come into your mind. Okay. This is the summary of section 24 and section 42. Clear. Now let's move on to how the partners are contributing. How the partners are contributing to a partnership and what is the return? What is the benefit given for that contribution? That means how the partners help, how the partners give their contribution to a partnership and what is the benefit that the partners get for that contribution. Okay. Now I am drawing a table like a summary. You also need to work it out with me. Take your writing book and make notes of this. Okay. So get the maximum out of this session, my dear students. This will help you for sure to get the entire marks at the question or at the examination. Okay. Fine. So I told you these partners can contribute to a partnership in 2 capacities. They can wear 2 masks. Mask 1, mask 2. Okay. Mask 1 and mask 2. So they can wear 2 masks and contribute to the capital. They can wear 2 masks and contribute to the capital. So those are known as capacities. Those are known as capacities. So based on the capacities, so based on the capacities, my dear students, accounting requirement will change, the benefit that they get will change. So keep in your mind, my dear students, every partner can wear 2 masks and contribute to the capital. Those 2 masks are known as capacities. First capacity is at the capacity of owners. Now partners are wearing the mask of owners. At that time they say, oh, we are the owners of this partnership. අපි තමයි මේකේ අයිතිකාරයෝ. අන්න එහෙම කියාගෙන කොහොමද contribute කරන්න කියලා මේ බලන්න. So we are the owners. They say, yes, we are the owners. This is our business, like our politicians say. This is our country. We are working towards to increase the wealth of this country. Likewise, they say. So at the capacity of owners. Okay. Here they say, we are owners. We are owners. This is our partnership. This is our partnership. That's what they say. We are owners. This is our partnership. That's what they say. Okay. So how they contribute? They will contribute to the capital. Yes, I told you when the owner is contributing, the first or the main way is contributing to the capital. Now, when contributing to the capital, what's the return that they can get? Through a partnership agreement, they can get interest on capital. But Section 24 says they can't. But in case if you put a clause to the partnership agreement, we can get the interest on capital. So if contributed to the capital, they will get interest on capital. If a partner engaged in the management, they will get partner's remuneration. Sometimes we name it as partner's salary. Both the terms are correct, but the technical term is partner's remuneration. And they bear risks. Now, we are the owners, so you know all owners are bearing risk as an entrepreneur. Okay, that is the risk of profit or loss. That's the risk of profit or loss, bearing risk. So for that, owners will get share of profit or loss. For that, the owners will get share of profit or loss. So as the capacity of owners, they can contribute in 3 ways. And for that 3 ways, they will get 3 types of returns. Keep those things in your mind. Then as an external party, when it comes to an external party, we say, no, we are not the owners. Now we are not the owners. We are a separate party from the partnership. Okay, as an external party, here they say, we are not the owners. We are not the owners. This is not our partnership. This is not our partnership. We are third party. We are an external party. That's how they say. As an external party, they can give loans. Now, if we are owners, if we give the money to the business, then it will become a capital. But now, if we are an external party, then how can it be a capital? So it can be a loan. Okay, they can give loans. If they give loans, they can get interest. To the loan, you know what we get as a return is the interest. They can give property on rent. So I am having a building. I would say I will give this building to do the partnership business, but as an external party, not as an owner. Okay. So if so, you can get a rent. Okay. You can get a rent. Then providing specialized labor. I'm a chartered accountant. I will provide accounting related specialized services. I'm a lawyer. I will provide the law service. I'm an engineer. I will provide engineering service. Likewise, if we are providing specialized labor, okay, relating to a profession, for that we can get an employee salary. There we are not engaging in the management as a capacity of the owner, but we are providing a specialized labor based on a profession. For that we can get an employee salary. Okay. Now, how to account these two? If the owners are contributing to the partnership at the capacity of the owners, then we consider them as profit appropriations. That means as the ways we give profit to the partners. Okay, profit appropriations means ways we give profit for the period to the partners. The profit we give. So how to record that? We are maintaining a separate account called profit appropriation account. We are going to debit that profit appropriation account and credit partners current account. Why crediting partners current account? Keep in your mind, I will teach them later also. This partners current account is an equity account. Therefore, we are increasing the equity. We are increasing the equity. To increase the equity. Why? Those profits are given to, those profits are owned by, those profits are earned by the partners. So that is their equity. That is their equity. We need to increase that. To increase that, we need to credit to partners current account. Okay. So capacity of owners as profit appropriation. But if we are contributing as an external party, then lamai, keep in your mind, we consider them as an expense. We consider them as an expense. Okay, so we are deducting that when calculating the profit. Here, the calculated net profit will be appropriated, but here we deduct when calculating the profit. We deduct when calculating the profit. When we do an example for this, you will get a good idea. Until then, just keep this in your mind, how the partners can contribute to the capital. Okay, great. Let's move on. Let's move on. What is the next one? What is the next one? Okay, we learned how the contributions are. Now let's learn how they are going to account, what they are going to use to account. What are the accounting and reporting instruments? Simply how they are going to account. Okay, so when it comes to accounting, not reporting, not presenting, okay, here accounting. Okay, accounting, when it comes to accounting, to demonstrate ownership and to appropriate, to share the profit. Okay, to appropriate the profit or to share the profit, to share the profit among the partners, we use accounts. Okay, to demonstrate the ownership, that means to demonstrate what? Ownership means the equity. To demonstrate the equity and to demonstrate the profit appropriation among the partners, we use accounting related instruments. Okay, now when it comes to a partnership business also, they are using the double entry system and they are maintaining all the records, but I am taking some key things which are specific to a partnership. Okay, so these are specific to a partnership. These are specific to a partnership. These are specific to a partnership. Keep a note. So to demonstrate the ownership and to appropriate the profit among the partners. To demonstrate the ownership, lamai, we are keeping two accounts. We are keeping two accounts, capital accounts and the current accounts. So keep in your mind, these two accounts are to reflect the equity. No, if they are to reflect the equity, okay, if they are to reflect the equity, those two accounts shall be equity accounts. Okay, those two are equity accounts. If those two are equity accounts, how to record the increase of the equity and decrease of the equity? So how to record them? Increase of the equity is a credit, decrease of the equity is a debit. Decrease of the equity is a debit. So credit to increase, debit to decrease. Onna oluvata yanna ona. Okay, onna oluvata yanna ona. Clear. And then the profit appropriation account, when it comes to the profit appropriation account, it is to distribute, it is to share the profit. No, it's to share the profit. This is also work as a equity account. This is also work as a equity account. Okay, the double entries are going like that. It's also a type of an equity account. Okay, but this is a temporary one. Okay, this is a temporary one. Once we appropriate the profit, this account will be zero. This account will be zero. Okay, clear. Now, to demonstrate the ownership, let's first learn reporting things and then we move on to in detail explanation. To reporting purpose as financial statements. Okay, to reporting purpose. So I will write as financial statements. Reporting purpose, financial statements. Reporting purpose, financial statements. So when it comes to the financial statements, we have statement of profit or loss and the statement of financial position. Statement of profit or loss and the statement of financial position. Those are the two key financial statements prepared by a partnership also. Now clear. So accounting and reporting. Now let's first learn partners' capital accounts. These partners' capital accounts are relating to the fixed equity or the long-term equity. Okay. Now let's see. This demonstrates the long-term equity. Keep in your mind, long-term equity lamai. Equity can be long-term and short-term in a partnership. So here the capital account shows the long-term equity. Sometimes we say the fixed equity. The most important fact is no recurring entries are made. Day-to-day entries are not made to this account. අපිට ඕන ඕන වෙලාවට we are not going to debit or credit this account. Okay, we are not going to debit or credit this account. Clear? The long-term equity. So then what are the transactions we are going to record in this account? The introduction of capital and additional capital. When a partner comes or when the business is initially starting, the contribution to the capital as owners will be recorded in this capital account. Okay. Then repayment of capital. When a partner is retiring, we will repay the contributed equity. Then that repayment will be recorded in the capital account. Now, if the introduction of capital is recorded in capital account, then the repayment shall also be recorded in the same account. No? එහෙම වෙන්න එපා. උඩ සාක්කුවට නම් ලක්ෂයක් දාගත්තේ ඒ ලක්ෂය එළියට දෙද්දී උඩ සාක්කුව වෙන්න දෙන්න ඕන. The same thing. Then the revaluation adjustment and the goodwill adjustment. You will learn these two also, the revaluation adjustment and the goodwill adjustment. So main four things at your level: introduction of capital, repayment of capital, revaluation and goodwill. Keep those four also in your mind. So this is how we prepare a capital account. So now you can see the same thing, the date description. And here the important fact is that since there are three partners, okay, since there are three partners, we are showing each partner's equity in each column. Okay, to show Lal's equity, we use this column. To here also to show Lal's increase in the equity, this column, this one in the credit side, and in the debit side to show the Lal's decrease in the equity in this part. Likewise, we use these columned capital accounts for that purpose. So my dear students, at the exam you need to be mindful. Why? Sometimes due to the exam rush you are afraid. You are stressed. Okay, many things are going on during that 3 hours time. So due to all this stuff, what will happen is, most of the time what will happen is students mix in these columns. Sometimes nihals are recorded in nimals, lals are recorded in nihals. Likewise, they mix up the partners. If you mix up the partners, then there is an issue, my dears. Then there is an issue. We can't help on that. Even the examiner can't help on that matter. So please keep in your mind to correctly identify the column. Okay, correctly identify which partner that the transaction is going to affect. That's an exam focus point. Okay, done. Now we learned about capital accounts. The key rationale is we use to record the long-term equity here. Then short-term equity. To show the short-term equity, we use current account. To show the long-term, not the long-term, to show the short-term equity here. To show the short-term equity, we use what? We use the capital, not capital, what? Current account. Okay, current account. Great. So there we mainly record the profit appropriations. You will learn how to do the ways. You will learn the ways to do the profit appropriation in a while. Okay. So all these profit appropriations are recorded in the current account. And then other transactions that increases the short-term equity and the distributions to the partners. So these transactions will be separately explained in another question. Okay. These transactions will be separately explained in another question. So nothing to worry. Just keep in your mind any transaction affecting to the short-term equity. Okay. Any transaction affecting to the short-term equity will be recorded in the current account. Now, you learnt about the capital account, my dear students. all the transactions other than the transactions recorded in the capital account are recorded in current account. That's very easy to keep in your mind. So all the transactions all the transactions other than the transactions we record in the capital account are recorded in the current account. Why? Because the transaction that we record in the capital account are fixed and small, only 4 things. Anything other than that we can record in the current account. This is how the current account is. Now, if the short-term equity is increasing, then we are crediting that. If the short-term equity is decreasing, then we are debiting that. Okay, clear. Okay, great. Now, you are very clear with the 2 things which are relating to the demonstration of ownership. What are the 2 things? Capital account and the current account. Now let's move on to identify the profit appropriation account. Why? To distribute, not the term distribute is very correct, but let's say to share, to give the profit. Okay, to give the profit among the partners, we use the profit or loss appropriation account. Though we say an account, we can show it as a statement. This is how it is. Nothing to worry, Lamai, nothing to worry. I will explain that to you. When we are doing a question. Okay, nothing to worry. These points are the ways of appropriating. These points are the ways of appropriating the profit to the partners. Okay, here if it is a minus one, here if it is a deduction, then the transaction goes as debit to profit or loss appropriation, credit to credit to current account. So all the minuses we record here will be a debit to the profit or loss appropriation account. Then for sure it need to be credited to the current account. Okay, here the minuses are debit to the profit or loss appropriation account. Then those are credited to the current account. Okay, super. I am not going to show profit or loss and statement of financial position. In your exam, it is less likely to test profit or loss statement and the financial position. Usually they are testing this capital account, current account, and profit or loss appropriation account. So now you have a good understanding. If you have any doubts, you can contact me. Okay, I will write my number here also. Note 77698147 If you have any doubt, you can contact me through this number. So I am ready to help you all. Okay, I'm eagerly waiting to help you all. So my dear students, you can contact me through this number for any doubt. And you can rewind the video. This is a recording, no? You can rewind the video and watch it again and again. Okay. Now, it's time to, before we are going for a question, we have to go ahead with another questions. Okay, that means calculation. Before we are going to a calculation, we need to go ahead with question number 10 and 11. Now, I told you we are having 18 questions. Okay, I told you that we are having 18 questions. Yes, this is 18 questions. So out of that, we have already completed 9. So it will be easy for you now. Okay, you can have a holistic understanding about the topic. Okay, great. So let's move on to the next part. show how the profit or loss is going to be appropriated. That means how the profit for the period is going to be appropriated. Profit for the period is going to be appropriated. This appropriation is done using what? This appropriation is done using the profit or loss appropriation account or else statement of profit or loss appropriation. Okay, we are doing it through that. Great. Now let's have an idea. We first get the net profit for the period, my dears. So from where we can get this net profit for the period? You need to have that idea. From where we are going to take this? We are getting this from the P&L. Okay, we are getting this from statement of profit or loss. You know, in the statement of profit or loss, what is the last figure? The last calculation is the net profit for the period. So we directly take that net profit for the period to here. Okay. And then we are adding interest on drawings. We are adding interest on drawings. Now, you know, in a sole proprietorship, if the owner takes goods or cash to the personal use, we consider it as a drawing. We consider it as a drawing. In a partnership, okay, to reduce these drawings, because there are 2 and more partners, no? Minimum 2. So, to reduce these drawings, clear? To reduce these drawings, in a partnership, the interest can be charged. Okay, interest can be charged. So that charge in interest will be added to the net profit for the year. Now, if we are writing a double entry for this, my dear students, how to record? I told you, this is kind of the profit or loss appropriation account. Okay, so here now we are adding. I told you if any item is reduced or if any item is deducted from the profit or loss appropriation account, then it is a debit. Okay, here think like this: interest on drawings. Now, interest on drawings need to be taken from the partners. It is not to give to the partners, need to be taken from the partners. Therefore, to taken from the partners, we need to reduce their equity. To reduce their equity, we are debiting current account. So here, debit to current account, credit to profit or loss appropriation account. Profit or loss appropriation account, PLA. Profit or loss appropriation account. Okay. Why? We need to collect it from the partners. Okay, the partners. Then net profit to be appropriated. So this net profit will be the appropriatable profit. That is, we are going to give in various ways to our partners. One way is interest on capital. Okay, one way is interest on capital. How to calculate? We calculate based on the capital figure. We are using an interest rate and multiplying it on the capital, and then we are getting. I guess you know this is a revision session. No? So then the partner's remuneration, then the interest on current account balances. Sometimes we can give interest on current account balances, but least likely. Okay, this is less likely to test. This is less likely to test. Then the profit or loss shares of profit or loss, Okay, done. Once we appropriate the profit, okay, how the entries are going on then? How the entries are going on here? All the deductions are debit to profit or loss appropriation account, and these will lead to the increase in the equity. Why? This profit is owned by the partner, so we need to show that their ownership to this profit. Therefore, we need to increase their equity. Therefore, we are crediting current account. Okay, we are crediting current account. But in case if this is a loss share, then it will go otherwise. You know, profit is an increase in equity, loss is a decrease in equity. No? So if this is a loss, It's a special situation. If this is a loss, then you know it will reduce the equity. Therefore, debit to current account, credit to profit or loss appropriation account. Profit or loss appropriation account. That's how the things are going on. It's a summary, okay? So ultimately, when the profit is appropriated, here, this when the net profit to be appropriated is appropriated, final balance should be 0. Final balance should be 0. Why? We are splitting. We are appropriating them to the partners. Okay, nothing left. So we do this using a profit or loss appropriation account. Profit or loss appropriation account. Here, this should be a +1. Okay, this should be a +1. I took that from your study text. There's a small typing error, typo. Here, this is an add-in. This is add. Okay, this is add. Okay, great. Fine. Now we have an idea about that. Now let's see how these transactions, okay, how these transactions affect into the variable equity or the short-term equity are recorded in the current account. This is very easy, my dears. Okay, what you have to know is you need to just simply get an idea on that. Okay. Now, when it comes to the transactions affecting to the short-term equity, okay, when it comes to the transactions affecting to the short-term equity can be the increased or short-term equity can be the decreased. Both the things can happen. No? Equity can be increased or the equity can be decreased. So some transactions affects to reduce the short-term equity. If we are going to reduce the short-term equity, we know we need to debit them. Here I have mentioned it as a debit. We need to debit them. Clear? No? Here we have to debit them. Then some transactions are there. Those are to increase the short-term equity. If we are to increase the short-term equity, we need to credit. Why? Current account is a equity account. Okay, it's a equity account. So when it comes to increasing in the short-term equity, that increase can be due to the profit appropriations. I told you why. Because the profits are owned by the partners. Why? Since the profits are owned by partners. The profits are owned by partners. Reasons but I'm not going to explain much in detail because it's a revision session. So I want to explain how to tackle in a short and sweet manner. Okay. So results of profit appropriations and other transactions. When it comes to the results of profit appropriation, now you know the ways that we can use to appropriate profit. So here, interest on capital, interest on current account, partners remuneration, and the share of profit. In the previous slide, I discussed that ways. Okay, so these are the ways. These are the ways that the profit can be appropriated. Other transactions. What? Settling business liabilities using partners' personal cash. If the business liability is settled through partners' personal cash, not the business cash, through the personal cash, then that personal cash need to be repaid back to the partners. Okay, because the cash is not business asset, it's a personal asset. Okay. In that situation, that amount is reimbursable. Okay, that amount is payable to that partner. So we are crediting that to the current account. Then paying business expenses through partners' personal cash. Paying business expenses through partners' personal cash. Now, expense is a business expense, but paying through personal cash. It is reimbursable. Okay, it's reimbursable. So that amount need to be credited to the equity account. Okay. Then partners payable to partners such as rent, interest, or any other. Yes. Now, when a partner is contributing to the business as a third party, as an external party, not as an owner, then the interest, rent, salary and any other things need to be paid. The payable part, okay, need to be paid. Payable part shall be usually a current liability, no? Accrued rent, accrued interest, accrued salary. All these things need to be recorded under current liabilities in a normal situation. But my dear students, those are need to be paid to the partners, no? We are having a separate account to show the entire payables to that partner. What is that? That is the current account. So instead of recording as a current liability, we can credit that to, okay, we can credit that to the partner's current account. Okay, here instead of recording as a current liability, instead of recording under current liability, CL, under current liability. Okay, clear. Then when it comes to the transaction that reduce the short-term equity, the profit appropriation result, one result can reduce the equity. What is that? That is the share of losses. Share of losses. And also, one thing additionally, I have forgot to mention here, share of losses, and also one other thing, please make a note, interest on drawings. Interest on drawings. Interest on drawings will also reduce the equity. Why? We need to collect that. We need to collect that from the partners. If we here, we means the business. If the business is to collect cash from, or collect the amount from the partners, then it will reduce the equity. It will reduce the equity. Okay. Then distribution to the owners. So there can be cash or goods drawings and payment of interest. Here, payment of interest on capital, partners remuneration, interest of current accounts. Now you can see these here. These three are profit appropriations. At the very first instance, when we are appropriating the profit, when we are showing the increase, okay, when we are showing the increase of the equity, we are crediting that. But in case if we pay that interest on capital by way of cash, okay, if we are paying that, when we are paying that, we are debiting that here, the payment. The key term here is the payment. When we are paying that in cash, we need to debit that to the equity account. Why? Now, let's say interest on capital is 1,000. This is the amount that the partnership owes. That means the partnership need to pay to the partners as a profit appropriation. Now, out of that, if we pay 500, then what we need to do? The net payable will reduce. Now, to reduce this 1,000, which is in the credit side, we need to debit that. Therefore, the payment need to be debited. Okay. Then paying personal expenses of the partners. If the personal expense of the partners are paid through the business cash, okay, paid through the business cash, then what will happen? Then it is also need to be recovered from the partner. Therefore, we need to reduce that. Then payment of interest for loans given by the partners. Now here, this one. If we pay the interest, then we can debit that there. But sometimes we can show the net result. It's something else, but just keep in your mind like this. So we have a holistic understanding now how the transactions affect to the current account. Okay, how the transactions are recorded. Now, in a very calm mindset, you can go through this flow chart. When you go through this flow chart, it will be very easy for you. I'm pretty sure you will very easily grab the essence. Okay, super. Now, it's our time to work out a question. It's our time to work out a question. Let me share that also. Now, it's our time to discuss the first question, okay, to get a good understanding. Okay, lamai. So let's read. Hasit, Visit, and Nesit are the partners of Ceylon Handlooms, which is in the business of exports of handlooms to international markets. Okay. Then the partnership agreements provides the following: profit or loss share. The profit and losses are shared among HV and N in the ratio of 2 to 1. Then HV and N are entitled to receive a monthly salary. Now the agreement here, the partnership agreements provide the following. Agreement itself says what they are providing. When the agreement itself says what they are providing, then the section 24 is not the thing which is relating. We should give the first priority to the partnership agreement. Okay. Then interest on the capital at the rate of 5% is entitled by the partners on the capital balance at 1st January 2023. Okay, then partners are entitled to receive interest at the rate of 15% per annum on the loans given by them to the partnership. Okay. Usually the partnership ordinance says what? Partnership ordinance says maximum 5%. Okay, 24 section says it's only maximum 5%. But here the agreement says maximum, not the maximum, 15%. Yes, we can proceed. Why? The partnership agreement is the most powerful. Then the partner's capital and current account balances are given. Here you need to very much keen why these current account balances can be given as debit balances and credit balances both. Okay. Sometimes they are given as debit balances, sometimes they are given as credit balances. Then you need to keep in your mind where to record them. Okay. Then there are some things given. So let's see what is the requirement. One, the profit or loss appropriation account, and then the partners current accounts. Okay, profit or loss appropriation account and the partners current account. Okay, my dears. Now we have the question here. So let me open it, the actual paper. Okay, so it will be easy for me. This is the paper. Hope you can see, and we can work it out. So what we need mainly two things: the profit or loss appropriation account and the partners current accounts. Okay, partners current accounts. So I am going to work out this entire question in rupees thousands. So here I am mentioning partners current account in rupees thousands, and the profit or loss appropriation account is also in rupees thousands. If you are doing any working, okay, here workings, then also you need to mention that the workings are in rupees 1,000. At the examination, showing the workings will be benefit you. Okay, showing the workings will benefit you, my dear students. Why? When you show the workings, it will be easy for the marking examiner to give additional marks in case if your final answer is wrong. Okay, final answer is wrong. Great. Now, so we can start. So first of all, as I told you, we need to look at the partnership agreement, and now we know Hasit, Visit, and Nesit are the partners. So here you can see in the answer, I have clearly mentioned that partners current accounts, Hasit, Visit, and Nesit. Hasit, Visit, and Nesit. In the both sides, debit and credit, both sides, I have mentioned it clearly. And even in the profit or loss appropriation account, you can see I have clearly identified what is the name of the partnership, then what is the statement or the account is, and then the period. So you also need to correctly identify those. Okay? You need to correctly identify and write at the examination. Clear? So when it comes to the question, first of all, what we can do is the easiest thing is what? The second one. We can record these balances here. Capital account balances and the current account balances at 1st January 2023. Let's record that. Okay. Let's record that. So here you can see I would write 1st January 2023 balance brought forward, BBF. Not the best friends. It's balance brought forward. So this is the current account. No? Actually, we are not preparing the capital account, so no need to write the capital account balances. So we have to write only the current account balances. Here also, I am putting in both the sides. Why? If you see, we have in both sides. Hasit has a credit balance of 150. Hasit has a credit balance of 150. Okay. Then Visit has a Visit has a debit balance of 300. Visit has a debit balance of 300. Debit balance of 300. For him, it's a debit balance. Okay. Then Nesit has a credit balance of 800. Nesit has a credit balance of 800. So here I recorded that. First of all, I recorded the balance brought forward. Okay. Next one. Now I can tick that. I'm putting a tick here. Then just let's glance through this one. Okay, let's glance through. Then they say a loan was given. Loan was given by Hasit on 1st July 2023 and the interest for the year was not yet accounted. Okay. Then the partnership business is operated in a building owned by Visit. Okay. A monthly rent 50,000 is payable to him. However, the rent for the year ended 31st December was not paid him during the year, and while said the expense is even not accounted in the books. I will explain just to glance through. Okay. Then a drawing by Nesit. And then for the year ended 31st December 2023, the total turnover is given. Okay. The total turnover is given. I don't know why, but they have given anyway. When they give, it's better to have it. When they give, it's better to have it. Okay. Then the profit was 8,000. Okay. The net profit is given. Clear, Lamai. Now we need to appropriate this net profit. No, but if you clearly see this, there are two transactions which are not accounted yet. Now, if you see, when a partner gives a loan, I told you that partner is giving the loan as an external party. So the interest payable need to be deducted as an expense when calculating the profit. But the interest for the period is not accounted. They say here, the interest for the period is not accounted. That means it is not expensed yet. We need to do that. Then a partnership business is operated in the building owned by Visit. That means Visit has given the building on rent basis as an external party, but the monthly rent 50,000 for entire year is not paid. And even it is not accounted. That means they have not recorded that accrued expense. So we need to do that. Now, when we are recording an expense, what will happen to this 8 million profit? That 8 million profit will get reduced. So first of all, what we need to do, we need to calculate the correct profit. Okay, so I am doing the working. So I will put as draft net profit. Draft, that means not correct. Okay, draft net profit 8,000. Okay, we need to do two adjustments. No, the first adjustment, what? Interest on loan. Who gave the interest or who gave the loan? Hasit. Interest on loan for Hasit. Okay. Now, how to work out that? If you see, the loan was given on 1st July 2023. Our period ends on 31st December 2023. That means this loan was there in the business not for the entire year, but for only 6 months. That means we need to give interest only for that 6 months period. Okay, we need to pay interest only for that 6 months period. So how to calculate the interest then? 1 million, I would take it as 1,000. And what is the agreement say? Agreement say partners are entitled to receive interest at a rate of 15% per annum. I considered that 15%. So 1,000 into 15%, if I multiply 1000 by 15%, then we will get for the entire year, but I want for 6 months. I want only for 6 months. So 1000 into 15% into 6 divided by 12. So you will get 75. 75 is the interest. Now, Lamai, this is an expense. When we are going to record an expense, what will happen? The profit will reduce, and this is payable to Hasit. I told you, any expense payable to Hasit is not going to be recorded as a current liability. We are going to record this at what? We are going to record it in the credit side of the current account. The payables to the partners are recorded in the credit side of the current account. Okay. So 75. So debit to P&L or debit to profit. I am going to reduce the profit. I am going to reduce the profit, and where I am going to record? I am crediting this. I am crediting this loan interest payable, or else I would say interest payable. Interest payable to Hasit, no here, Hasit. Interest payable 75. I am crediting. Okay, I am crediting. Okay. Interest payable credited to Hasit. Then next one. It is done. These are very easy, my dear students. Okay. Then the partnership business is operated in a building. So building rent. Building rent. It's also an expense. We need to reduce the profit. So monthly rent is 50 into 12. 50 into 12. So 50 into 12 is 600. It is 600. So this entire 600 need to be recorded as an expense. Then the profit will be reduced. And this is payable to visit. Payable to visit. So then the next one. Rent payable to whom? Visit. Rent payable to visit. So it is how 50 into 12. So it's 600. So here rent payable. Rent payable. I am crediting to visit 600. 600. Okay. You also can record that 600. Done. Now that's all about that's all about the profit related things. Drawings are not deducted as an expense. I guess you know that. Okay. No any other things. No any other expenses. Okay. These salaries are profit appropriations. Okay. These salaries are profit appropriations. Here the partnership remuneration. And the interest on capital is a profit appropriation. Not deducted. Not deducted. Okay. Done. So now we can get the correct profit. Okay. Correct profit. Correct profit. It is 7,325. 7,325. So here I am going to the profit or loss appropriation account. So net profit for the year. Now we are taking the correct one. Now we are taking the correct one. We need to appropriate the correct profit. Okay, great. Now I'm moving back to the question. Here, additional point number 5 says there is a drawing, but no any information relating to the interest on drawings. And even the section 24 is also silent on interest on drawings. Therefore, nothing to do. Here, nothing to do with the interest on drawings, but we need to record this drawing, my dears. We need to record this drawing. So how to record this drawing? When I have told you, when a drawing is done, it will reduce the equity. Therefore, we need to debit this drawing for NESIT. Okay, NESIT in the current account. Here, drawings. Drawings, Hasit, visit, NESIT, 1,500. 1,500. Okay. 1,500. Done. Done. Okay. Then next one. Here the last one also considered. Now what we have to do is only the profit appropriation. Those are very easy, my dears. Those are very easy. How to do? First of all, I would give the interest on capital. So rate 5, the capital balances at 1st January 2023. Okay. First of all, I would put what? First one. First one, that is interest on capital. Interest on capital. Interest on capital. So we have Hasit, Visit, and Nesit. Separately, I am mentioning Hasit, Visit, Nesit. You also need to do like that, okay? You can't directly put the entire thing. Hasit, Visit, and Nesit. How to get the answer? How to get the answer? We have for Hasit 2000, 2500, and 3000. Okay, here 2000. What is the interest rate? It's 5%. Interest rate is 5%. Okay, 2000 into 5%, and then 2500 into 5%, and then 3000 into 5%. Yes, 3000 into 5%. So how I can get the answer? How I can get the answer? In Excel, I can directly copy and paste this, and then I can get here 2000 into 5%, 100, 125, and 150. So all together, if you can see, all together, we have appropriated. Okay, I will put it as a, sorry. All together, we have appropriated 375 as interest on capital. So how to record this then? Here, this is a reduction. Here, debit. This is a reduction. I'm putting this as a debit, my dears. Reduction. Minus dollar and total, it's okay. But here I'm taking as a plus, and then the total I will take as a minus. So how to record that? This is a debit, and this is a debit to the profit or loss appropriation and credit to the partner's current account. Why? It is the ownership. It is the ownership on the profit. Okay. So interest, I would simply say int on capital. Interest on capital. So 100, 125, and then 150. 150. Here I recorded that. Okay, interest on capital done. Then what else? Then the partner's remuneration. Partner's remuneration, or is partner's salary. Partner's salary. Partner's salary is also for Hasit, Visit, and Nesit. Let's see how the things are going on. Hasit, Visit, and Nesit, respectively 50, 75, and 125. Okay. 50 into 12. Then 75 into 12. Why? The monthly figures are given. Then 125. 125 into 12. All these figures are given for monthly. Okay, monthly. So for Hasit, it is 600. For Hasit, it is 600. For Visit, it is 900. For Nesit, it is 1500. 1500. Okay. Now altogether, we are giving partner salary. We are giving 3000 as partner salary. So how to do? We need to credit partner's salary. We need to credit to, okay, we need to credit to there. So 600, 900, and 1500. Hasit, Visit, and Nesit. Great. Now, net profit for the year 7325 was splitted. Oh, given as interest on capital 375. So the balance is 6950. Okay. Then from that, we give 3000 as partner salary. Okay. Then we have 3950. So among the main profit appropriation ways, 2 ways are already done. So the balance way is what? We are giving the balance 3950 profit as what? Profit shares. Share of profit. Share of profit. I am giving that to Hasit, Visit, and Nesit based on the profit sharing ratio. Let's check. Hasit, Visit, and Nesit 2:1. The profit sharing ratio is 2:1. Okay, how to do that? Here 3950, the total amount. No? the total amount need to be distributed. So 2 to 1 is the ratio. So 2 to 1 is the total 5. So divided by 5 multiplied by 2 for visit. Then the same for Hasit and visit both. Why 2, 2. And then the balance one, 2 to 1. 2 to 1. So I divided by 5. Okay. It's very easy. Okay, 1580, 1580. Then 790. Now, if I take the total here, it will be 3950. So my dear students, here the balance is 0. As I told you, if you can remember, once we are done with the profit appropriation, the balance will be 0. Okay. Now we need to give this share of profit. So how to give the share of profit? I need to credit 1580, 1580, 1580, 790. Okay, done. So we are done with the profit loss appropriation account and then the partner's current account also. Okay. So how to do that? Partner's current account. Now you can see usually the credit side is higher. I am taking the total of each column. And then I need to take the same total for same columns. Okay. The same total. You know how to balance a T account now. So I am taking the same total here. And then I would take the balance carried down. So 31st December 23, balance carried down. How to get? 2505 less any debit transactions, nothing. So the same amount will be carried forward on 1st January 2024, balance brought forward. So the answer will be how much? The answer will be we are taking forward 2505 for Hasit. Then for visit, 3205 less this 300. So it is 2905. Then for Nesit, 3240 less this 1500. It is 1740. Sorry, it is 1740. Okay, done. This is what you are expected to. If you do this properly, you will get how many marks? If you do this properly, you will get 10 marks. Okay, done. Very easy, no? Okay, so now we discussed the theory part relating to profit or loss appropriation and the partner's current account. Now we prepared. We are very capable of this. Then let's move on to the next part. Now, after completing that part, my dear students, we are going to learn when the composition of a partnership changes and how to do those accounting part. Now, as per your syllabus, there are main two instances when the composition of a partnership can be changed, my dear students. Okay, there are many, but in your syllabus, we are considering only two things. So, what are the two things? Okay, what are the two things? One is when hiring a new partner. How it happens? We had A and B within the partnership. Now, a new partner will be coming as C to the same partnership. That is called hiring a new partner. Retiring an existing partner means A, B, and C were there in the partnership, and now C is going to go out from the partnership. That is called retiring an existing partner. Okay, done. Now, as per your syllabus, this hiring or retiring can be happen either at the beginning of the year and at the end of the year. In case if this happens in the middle of the year, it's a really headache for us. Okay. So for your easiness, in the syllabus, they have mentioned that the time this composition change can take place at the beginning of the year or at the end of the year. Now, when such a composition changes happen, what are the special adjustments need to be done in such situation? Okay, there are main two things we need to adjust. One is the goodwill, and other one is the revaluation gain or losses for those assets. So here we will adjust revaluation gains and losses for the assets. Okay, assets and the goodwill. Goodwill, you know, goodwill in the sense our good name, our reputation, our ability to get more and more customers. So this goodwill need to be adjusted. Okay. When adjusting the goodwill, we have many methods, Lamai. We have many methods, but in your syllabus, they say this goodwill adjustment need to be done through partners' capital accounts. Okay. This goodwill adjustment need to be done through partners' capital accounts. And when adjusting the revaluation also, there are mainly two methods. Out of that two methods, in your syllabus, they say always we need to assume that the assets are kept at the revalued amount. Okay, assets are kept at the revalued amount. So the asset accounts will be increased or decreased depending on the revaluation gain or loss. Depending on the revaluation gain or loss, my dears. Okay. Now, when we do this adjustment to goodwill and revaluation, okay, when we do this adjustment to the goodwill and revaluation, simply the goodwill is there and the revaluation can be there. The important fact is the revaluation sometimes can be a gain, sometimes can be a loss. Okay, you have learned LK 16 for this. You have learned LK 16 revaluation of PPE items. So usually this revaluation gains or losses are related to that. Okay. So when the goodwill is going to be adjusted, my dear students, we have two methods. We can adjust the full goodwill of the partnership. That means the goodwill of the entire business. We can adjust the goodwill of the entire business, or else we can adjust for the goodwill portion of the partner. Now, if we have the goodwill of 500 for the entire business, okay, then that is, if we adjust in that, then it is known as adjusting for the goodwill of the partnership. Or else we can say this 500 is collectively owned by ABC. Okay. Now, if we are going to adjust the goodwill portion, then we are calculating how much of goodwill owned by, or else how much goodwill can be attributable to one partner. Okay, that is calculated. This portion is calculated based on the profit sharing ratio. Okay, calculated based on profit sharing ratio, my dear students. Calculated based on the profit sharing ratio. That means the full goodwill, the total goodwill into the profit percentage or the profit ratio. Okay, profit ratio. That's how we calculate the goodwill amount relating to a partner, one partner. Okay. Great. So adjusting the full goodwill of partnership, same treatment when a new partner comes over and exit. Why? I told you that we have two situations, a composition change. One is when a new partner comes, or else an existing partner retires. Even irrespective of the two instances, the same treatment will be done. What we'll do, we will debit the capital account in new profit sharing ratio. Here new ratio means new profit sharing ratio, and we credit it at old profit sharing ratio, the old ratio. So what we will do is, we will credit to capital account at old ratio and debit to the capital account at new ratio. There is a very good rationale behind this. I'm not going to explain the rationale, as this is not a theory session, but just to wrap up all the stuff to make sure that you do the question well. So for that, how to do it is enough rather knowing why doing. You should know why doing. I believe that in your theory courses, in your classes and other methods, you have learned the theory aspect. I am assuming that, okay? Fine. So debit to capital account and credit to capital account. Debiting is done using new ratio and crediting is done using old ratio. But lamai, when we are going to adjust the goodwill portion of the partner, that is quite different thing. Okay. So when we adjust that in a situation where a new partner is hired, it will differ from how we are going to adjust when existing partner is retiring. So two things, two situations, two different methods. When a new partner is hired, okay, when a new partner is hired, we need to get money for the goodwill that we are giving to that partner. That means when that partner is coming to the business, the business's goodwill will be splitted to that partner also. No? That means we are giving a portion of goodwill to that partner. Okay. Therefore, we need to take money. We need to take money from that partner for the goodwill that we give to him. For that, we are debiting the capital account of the new partner. And we are crediting that amount to the old partners at sacrificing ratio. I will teach you it later, okay? At sacrificing ratio. Debit to capital account of new partner, credit to capital account of old partner at sacrificing ratio. And then when the retirement is done, what will happen? What will happen? When a partner is retiring, the remaining partners will have to give cash, or partners will have to give money equivalent to the goodwill earned by that partner, by the retiring partner working throughout the period. Therefore, we need to give, the existing partners need to give the retiring partner cash, not the goodwill, but the cash equivalent to that goodwill. Therefore, the goodwill portion of a retiring partner will be credited to the capital account of the retiring partner, and we are debiting to the remaining partners at gain-in ratio. At gain-in ratio. I will teach you sacrificing and gain-in ratios in a while. Okay. This is how the goodwill is adjusted. When it comes to the revaluation gain or loss, okay, it is also the same treatment. When a new partner comes to an existing partner retires, nothing changed. So I told you we assume one thing. We assume one thing. What is that? We assume all the time the assets are kept at the revalued amount. That assumption is there during the entire period. Okay. So fine. So debit to relevant asset account. Okay. Debit to relevant asset account. Why? If it is a profit, my dear students, revaluation gain, the asset value will be increased. Therefore, we need to debit to the asset account and we need to credit to the capital account at old profit sharing ratio. Okay. Capital account credit karanne old profit sharing ratio. In case if it is a loss, otherwise, it's a loss, no? Equity reduces. Therefore, we are debiting that loss to capital account, not to the current account. Keep in your mind, this goodwill and revaluation adjustments are done to the capital account. Okay. So we are debiting that to the old profit sharing ratio. Debiting capital account to the old profit sharing ratio, credit to the relevant asset account. Why? It's a loss. Loss will reduce our asset value, my dears. Loss will reduce our asset value. This is the entire summary relating to goodwill and revaluation adjustment. If you are familiar with this, I'm pretty sure any question relating to goodwill and revaluation adjustment can be attempted and successfully get the entire marks. Successfully get the entire marks. Okay. Now let's see how to calculate the sacrificing and gaining ratio. So sacrificing ratio and the gaining ratio. First of all, let me explain the simplest rationale behind this. Okay. Simplest rationale behind this. Then we will go for the calculations. Okay. Sacrificing ratio. Sacrificing means what? We are giving up. No? We are giving up. Now, earlier, think A and B partners were here. A and B partners were here. So they shared the profit 50-50. Okay. Now, a new partner comes into play a new partner comes into play. Now there are three partners here, A, B, and C. Now they share profit. Okay, now they share profit. How? 50-50 කියන එක වෙනුවට okay 50-50 ගමුකෝ. It's okay. So let's take 50-50. Earlier we had 50-50. Now what will happen? Now this partner 40, A 40, B also 40, C is getting 20% out of the total profit. Now can you see, due to the entry of new partner, earlier two partners had to sacrifice what they got earlier. Why? Earlier, they got here, A and B both earlier got 50% out of the profit. 50% out of the profit. But due to the entry of new partner, now they are getting only 40 here. Now they are getting only 40. The new partner is getting 20%. What happened? Earlier A got 50, now getting 40. That means A has sacrificed 10 and given that 10 to the C. B has sacrificed 10 and given that 10 to the C. So A 10%, B 10%, they both equally contributed and given 20% to C. So that's called sacrificing, my dear. Sacrificing ratio. Okay, sacrificing ratio is this one. This one. The amount sacrificed is put it as a ratio. Okay, we can do this by looking at the rupee values or else by looking at the ratios. Usually how we calculate the sacrificing ratio and gaining ratio is by looking at the old profit sharing ratio and the new profit sharing ratio. Clear? That's the theory behind it. You can rewind and watch. Then the gaining ratio. Let's see like this. Earlier, there were three partners, A, B, and C. A got 40%, B got 40%, C got 20% earlier. Okay. Now, an existing partner plans to retire. Okay. Then what will happen? Then only A and B will remain. A and B will remain. When A and B is remaining, they are agreeing to share their profits at 50-50 rate. 50-50 rate. Clear? No? 50-50 rate. Okay. Now, what has happened? Earlier A got only 40. Now A get 50. So now A get 50. Earlier got 40. How much A has gained? How much A has gained? 10%. A has gained 10%. And then B. Earlier B got only 40, but now getting 50. So B also gaining 10%. When it comes to C, now C is no more. Now C is getting 0, but earlier C got how much? Earlier C got 20. That means what has happened? Nothing gained. Here nothing gained. That means minus 20. That means what has happened? This C's 20 had been splitted among A and B equally. The retiring partner's share of profit will be splitted among the existing partners when that partner retires. Okay. The ratio that the retiring partner's profit splitted among the existing partner, the remaining partners, is known as the gaining ratio. Okay. So this is what called gaining ratio. Now it's very clear, Lamai. Sacrificing ratio is calculated when a new partner is hired. Gaining ratio is calculated when an existing partner is retired. So in your past papers, this sacrificing ratio is severely tested. Okay. So I will do a calculation relating to sacrificing ratio using the same method. By turning up and down, you can calculate the gaining ratio also. So I will do one example related to sacrificing ratio. So based on that, you can tackle the exam questions even for gaining ratio also. Okay. Here we need to take the difference. Therefore, always keep in your mind, we need to get the difference by deducting the low amount from high amount. Here what I did, I deducted the low amount from high amount. Okay? Low amount from high amount. So, in calculating the sacrificing ratio, what I did, here 50-50 was the old profit sharing ratio. And I deducted the new one. So, from old one, I deducted the new one to calculate the sacrificing ratio. When calculating the gaining ratio, the new one is the higher. The new one is the higher. So what I do is, new one is there and I am deducting the old one from the new one. I am deducting the old one from the new one. So it's very easy to calculate the sacrificing and gaining ratio. How? If to calculate the sacrificing ratio, we need to deduct new one from the old one. If to calculate gaining ratio, we need to deduct old one from the new one. That's quite easy. No need to memorize, but to have that understanding. Okay, so let me erase the ink on slide. Sacrificing ratio when a new partner is hired, gaining ratio when an existing partner is retired. So old minus new, new minus old, new minus old. Done. Now let's do a calculation. So let's read. Saman Amal were the partners of SA Associated and shared profits and losses equally. Equally means 1 to 1. Equally means 1 to 1. Okay. Equally means 1 to 1. During the year, Bimal joined as a partner and it was decided to share the profits among SAB, Saman, Amal and Bimal at 3-to-1 ratio. Okay. Calculate the sacrificing ratio of Saman and Amal. Okay. How to do? Now you know, calculate the sacrificing ratio. Always we need to deduct the low from high, no? Low from high. When a new partner arises, earlier one, the old one is higher, the new one is lower. So, how to do? So, Saman, Amal, and Bimal. Okay. මෙන්න මේ method එක හොඳට ඔලුවට දාගන්න. Okay. Saman, Amal, and Bimal. Okay. Now, first of all, we need to take the old one because it is the higher. So, old profit sharing ratio 1 into 1. Nothing for Bimal because he coming, he's the newcomer. No? Then the new one, we need to deduct new one from that old one. So, here need to deduct 3, 2, and 1. 3, 2, and 1. Now, Ulamai, is the denominator, is the upper value is same, if the totals are same, okay, if the totals are same. Now can we do this sum? Can we do this sum? Why? The first one, the total is 2, the second one total is 5. That means the denominator is not same. We need to get the common denominator. We need to get the common denominator. How to get the common denominator? You know, we need to do the cross multiplication. How to do the cross multiplication? You need to multiply the old one here. You need to multiply the old one with 5, new one with 2. New one with 2. That's how to do cross multiplication. So let's do. So old one is 5. Here it will become 5, 5. Okay, 5, 5. So the total will be 10. And then the new one by 2. So here it is 6. It is 6 and it is 4. Okay. Right. It is 4 and it is 2. It is 2. Okay. It is 2. Great. No, wait. Here the total I went wrong, no? Here the total is 6, my dears, not 5. The total is 6. Sorry, I made a mistake there. The total of the new one is 6, no? Here 6. So here it should be, I made a mistake. So the old one need to be multiplied by 6. So here it is 6 into 6. Okay, so the common denominator will be 12. And then 2 into 3 is 6. 2 into 2, 4. 2 into 1, 2. 2 into 1, 2. So it will be 12. Now we can do the summation. Here we will get the sacrificing ratio. Here we will get the sacrificing ratio. How to interpret this? Earlier someone got 6. Now also someone getting 6. That means nothing sacrificed. Here it is 0. Nothing sacrificed. Okay. Then what has happened? Amal earlier got 4. Amal earlier got 6. Amal now get 4. How much he has sacrificed? He has sacrificed 2. And what has happened? Amal has sacrificed 2 and given that 2 to Bimal. So the sacrificing ratio among Saman and Amal, they have asked for that, no? Sacrificing the old one. So Saman and Amal sacrificing ratio is 0 into 2. Yes, 0 to 2. That means what has happened? Saman has nothing sacrificed. Only Amal has sacrificed. Amal has sacrificed 2 profit portions and given that 2 to Bimal. Given that 2 to Bimal. So you can do the working like this. It's very easy for you to do. Done. Done. Okay. Now we are moving to another thing. The last 2 things, my dear students. How to account, how to do the calculations when a new partner is hired. How to do the calculations when a new partner is hired. Let's learn how to do that. Okay. This hiring can happen at the beginning of the year or at the end of the year. Okay. So if it happens at the beginning of the year, now a few things you need to take into your mind. The first main thing that you need to keep in your mind is, if the new partner is hired at the beginning of the year, do we need to give profit for him? Do we need to give profit for him? Yes, we need to give profit for him. Why? He's there. He's there for the entire year. So he is entitled to the profit. Okay, that you should keep in your mind. First one, how to do? First of all, we need to record the capital introduced. We need to record the capital introduced. Why? The new partner is bringing up the capital now. So first of all, we need to record the capital introduced. And then we need to adjust for the goodwill. Okay. And then we need to adjust for the revaluation if given. If given in the question. If not, do not do. Okay. Only if given in the question. Then consider the balance after about 3 for interest on capital calculations. Yes, the profit need to be appropriated to the new partner because he's hired at the beginning. Then when we are appropriating the profit, we need to get the interest on capital. To get the interest on capital, we need to have the capital balance. We need to take the capital balance after these 3 adjustments. After these 3 adjustments. Keep in your mind, most of the time, the suggested answers also sometimes vary, but the rationale is we should get the net balance after all these adjustments to calculate the interest on capital. Interest on capital. Okay. Great. Partner is entitled for the current year profit, therefore appropriate profit. Yes, this is the pretty important thing. When he is hired at the beginning of the year, okay? When he is hired at the beginning of the year, we need to appropriate the profit for him. But if hired at the end of the year, partner is not entitled to the profit. If he comes at the end, why do we need to give the profit we earned during the year to him? It's not going to work, okay? Therefore, we do not need to appropriate the profit to the partner. Just record the capital introduced, adjust for the goodwill, and adjust for the revaluation. That's how we need to do. But in case, if this is a full question, then after doing the profit appropriation, only we are going to do this. Okay. After doing profit appropriation, we can do this. So the key thing you need to keep in your mind, we need to record for capital, goodwill, and revaluation. Okay. Other key point is, if the partner is hired at the beginning of the year, then we need to pay interest on capital, or we need to pay the profit, If the partner is hired at the end of the year, we do not need to pay the profit. Done. Okay. Okay, my dears. Now we have to work out a question. Just let's glance through and we start the working. Okay. So this is a question relating to a partner arrival. Damit and Udit are in a partnership, DU fashion, sharing profits and losses in the ratio of 2 and 1 respectively. Okay. A new partner is admitted. A new partner is admitted. Then let's see what's the requirement. Then only we go through. Okay. What's the requirement? You are required to prepare the following for the year ended 31st December 2022. Okay. The dates are very important, Lamai. Okay, dates are very important. We need to prepare the current accounts and the capital accounts. Current accounts and the capital accounts. Okay. This question is from 2021 July past paper. So now let's start working on this. Great. Now let's discuss an in-depth question. So let's read. Damit and Udit are in a partnership of DU version, sharing profit and losses in the ratio of 2:1 respectively. On 1st January 2020, usually 1st January means the year beginning. At the examination also, you need to highlight like this, you need to make notes like this, then only you can simply go through without any mixing of information. Okay. Meena admitted as a new partner arrival to the partnership with an initial cash investment of 8 million. When Meena comes, she has bought 8 million. Very good, no? She has brought 8 million. Okay, super. The following balances were extracted from the books of accounts. So the opening capital balances are given. Then the capital introduced by Meena. It has not recorded in the capital account yet, okay? Because it has recorded in a separate account. Then current account balances, the opening, and then the drawings, the during the year drawings. Okay. Goodwill of the partnership. Here, goodwill of the partnership was valued at 2.4 million on 1st January. That means at the arrival of Meena. Here, the key point is goodwill of the partnership, not the entire, it's the entire goodwill of the business, not the goodwill portion of Meena. Okay. And it was decided to adjust to partners capital account without creating a goodwill account. Yes. What I said, what we need to do, debit to capital account, new ratio, credit to capital account, old ratio. That's all. Then the non-current assets were revalued. So we need to calculate the revaluation gains and losses. Then non-current assets were carried at revalue amount. I told you here, it was agreed that non-current assets were carried at revalued amount in the partnership. In your syllabus, my dear students, we use that assumption in every instance, the revalued amounts are carried at, or the assets, non-current assets are carried at the revalued amounts. Okay. Then the new partnership agreement details are given. Okay, new partnership agreement. That means new partnership agreement with Damit, Udit, and Meena. Damit, Udit, and Meena. Okay. Interest on capital at 10% per annum is to be paid for the capital balances as at 1st January 2022. Now I told you this new partner is coming at the beginning of the year. So after doing all the adjustments, recording the initial capital, adjusting the goodwill, adjusting the revaluation, after that we will get a capital balance. So we need to calculate the interest on capital for that balance, my dears. Not for any other. For that balance only, we are going to calculate the what? We are going to calculate the interest. Okay, we are going to calculate the interest. Keep that in your mind. Okay. The reason for that is the capital amount invested in that business will be, okay, will be the net amount after that adjustments. Because when we do that adjustment, the capital structure will change. Okay. No more that is the amount invested by that person. So after that amount need to be considered, my dears. Udit is entitled to receive a monthly salary. Profit and loss 4:3:3 ratio. This is the new profit sharing ratio. Old one was what? Old profit sharing ratio was what? Old profit sharing ratio was 2:1. 2:1. Great. Then the net profit was given. Net profit was given 6,480. Okay. Now, when I read this question, there were no any adjustments required. Okay. No any adjustments required to the profit. No any adjustment required to the profit. So we can directly split that profit, my dears. We can directly split that profit. Okay. Clear. So we can do a working for that also. We can do a working for that. So here I am doing a working. Working is in rupees thousands. Working is in rupees thousand. Let's follow the process that I told you. Okay. So these accounts are also I am going to prepare in rupees thousands. Partners current accounts. I am going to prepare these accounts in rupees thousands, my dears. Okay, done. Done. First of all, let's put the opening balances. Let's put the opening balances. Capital account, usually we have credit balances. So 1st January 2020, balance brought forward. Balance brought forward. Let's take Damit and Udit, 12,000 and 8,000. Damit and Udit had 12,000 and 8,000. Okay. 12,000 and 8,000. But Meena do not have an opening balance. She comes on that. Okay. Then the current accounts. Current accounts, Damit and Udit, let's check. Current accounts, Damit has a credit balance of 1,500. Udit has a debit balance of 800. Okay. Damit 1,500 credit. Udit has what? Udit has a debit balance of 800. Udit has a debit balance of 800. Okay. Okay. Done. Then what I told you. Then we are going to record what? Since this is the beginning, then we are going to record the capital introduced. How? The capital introduced. Capital. How much capital? Or else you can put it as cash. Cash naranga, so we write it as cash. Meena. The capital introduced by Meena also 8,000. So here credit to Meena's capital account. It was in a separate account. I am debiting that separate account and crediting that to the Meena's account. Done. Then we need to do the goodwill adjustment. How to do? We need to debit partner's capital account, here goodwill, at new rate. And we need to credit partner's capital account for goodwill at old rate. So old rate was what? Old rate. Here, old rate was 2:1. For Damit and Udit, 2:1. අපි ඒක පොඩ්ඩක් මෙන්න මෙහෙ ලියා ගමු. Old rate and new rate. Old rate for Damit, Udit and Meena. Here, Damit and Udit 2:1. New rate. This is for understanding purpose, okay? New rate it was 4:3:3. 4:3:3. Okay. It is 4:3:3. Okay, my dears. Done. Now let's do that. So here, if I get the totals, old rate total is 3, new rate total is 10. Why? Since I need to split the entire goodwill based on these rates. How to do that? Let's take the goodwill. the business goodwill, how much? The goodwill of the partnership was 2.4 million. Okay, 2.4 million. So how to do the adjustment then? How to do the adjustment? Here, Damit. Damit will get, okay, 3 out of 2 here. Sorry, 2 out of 3. 3 deka. Okay, Damit will get 3 into 2. 3 deka. 3 deka. Clear. All rate. 1600. And then, okay, it will be very clear if I record it like this here. Let me record it like this here. All rate here 2400. No? 2400. How to do that? Damit will get divided by 3 into 2 divided by 3. Sorry, divided by 3 into 2. And then here the balance part divided by 3 into 1. Okay. Then the total is 800, 2400. So likewise, based on the ratio. Okay. I have credited. And then I need to debit using the new rate. How to debit? So the total is 2400. Damit will debit what? The Damit's capital account need to be debited 2400 divided by 10 into 4. This 960. Then for Udit, 2400 divided by 10 into 3. Then 2400 divided by 10 into 3 again. Okay. Now we did that. No, now we did that. This is how the debits need to be done. Okay. Now if you see this 2400 just splitted, my dears. Goodwill. So debit 960, 720 and 720. 720. That's how we do. So credited goodwill based on old rate, debited goodwill based on new rate. New rate. Okay. This is the goodwill adjustment. This is the goodwill adjustment. Okay. Then again we have another adjustment. What is that? Revaluation adjustment. Revaluation adjustment. How to do the revaluation adjustment? First of all, we need to calculate the total, the net revaluation gain or loss. How to calculate the revaluation gain or loss, my dears? We need to compare the revalued amount with the carrying amount at the revaluation date. So here, so we need to get the revalued amount. I would put RA and the carrying amount CA. By comparing these two, we can calculate the gain or loss. We can calculate the gain or loss. So first one, we have land and building. So L and B, land and building. Revalued amount 6,000. Revalued amount 6,000. Okay, revalued amount 6,000. But let's check the carrying amount. Here, carrying amount. They have mentioned 4,000 as the cost and accumulated depreciation 600. So the carrying amount is 4,000 less 600, 3,400. Very easy, no? Cost less accumulated depreciation. So here 3,400. Okay, 3,400. Now you can see the carrying amount is 3,400. We have revalued it to 6,000. 6,000. It's an increase in the carrying amount. That means this is a gain. This is a gain. Okay, it's a gain. Then after land and building, we have motor vehicles. We have motor vehicles. The revalued amount is 1,400. Okay, revalued amount is 1,400. 1,400. Carrying amount. The cost less accumulated depreciation. Cost 2,000, accumulated depreciation 1,000. That means cost less accumulated depreciation is 1,000. Carrying amount is 1,000. That means the carrying amount 1,000 we have revalued. We have increased it up to 1,400. That means it is also a gain of 400. So my dears, the net or the total one, the total gain is how much? The total gain is 3,000. Now this total gain Now this total gain need to be, okay, my dears. Now this total gain need to be recorded or else splitted in the partner's capital account based on the old rate. Based on the old rate. You can watch the recording. I clearly mentioned that, okay? Based on the old rate. So how to record it based on the old rate? Old rate DU. Here, old rate DU. How to split? Damit and Udit. So 3000 divided by 3 into 2. Into 2 for Damit. 2 for Damit. And 3000 divided by 3 into 1 for Udit. That is how we need to record. That is how we need to record. Okay. That is how we need to record. So here the revaluation. I will go to the capital account. Revaluation. Damit credit 2000. Udit credit 1000. Udit credit 1000. Udit credit 1000. Okay. Done. The revaluation adjustment is also done now. Great. Now we can balance this account. Now we can balance this account and get the capital account figure to calculate what? Get the capital account figure to calculate the total what? The total interest on capital. Okay. So let's balance off this account. Let's balance off this account. Okay. So here 15,600. 15,600. Sorry. It is 9,800 and 8,000. 8,000 in the credit side. And I am going to put those figures here. Put those figures into the other side. Then I can get the balance carried down. So this carrying down is also done on the first date itself. Okay. Here I am carrying it down on the same date to get the figure, just to get the figure, balance carried down. So 15,600 less 960, it is 14,640. So this is the balance brought forward on the second date. Balance brought forward PPF on the second date. So it is 14,640. And then for Udit, it is 9,080. It is 9,080. And for Meena, it is 7,280. 7,280. Okay, my dears. 7,280. Done. Now we recorded the stuff. Okay, we recorded the new hiring stuff. New hiring stuff. Then what we need to do? My dears? Then we have another thing to do. Okay. Then we have another thing to do. So I recorded this one. I recorded all this stuff. Then I can record this drawing also to complete the information mentioned in that. So debit to what? Debit to current account. This Damit's drawing. Debit to current account. Okay, Damit's current account I am debiting. Drawings. Okay. It is how much? 900. It is 900. Okay. No drawings for Udit and Meena. Now what I have to do? Now I have to split the profit, appropriate the profit. Okay. So let's see how I am going to do. I'm going to do a summarized manner. Just check. Okay. Net profit. Net profit. Net profit given in the question. Net profit given in the question. If you see 6,480. Okay. 6,480. I have the net profit. I have the net profit. Okay. Then out of the net profit, first we will pay the interest on capital. First we will pay the interest on capital. So, you know, when we appropriate the interest on capital, what will happen? That will credited to the partner's current account. Now, how to get that? We do not need to do a separate working. Why? We have the capital account balances here. We have the capital account balances here. Based on these balances, we need to just apply the interest rate. So interest on capital 10% per annum. 10% per annum. Very easy. So how to do that? How to do that? 14,640 into 10%. You also can do this in your calculator. You can also do this in your calculator. Okay. So likewise, I am getting the interest on capital. So let's check all together. How much is the interest on capital here? You can see the total. The total interest on capital is, the total interest on capital is, sorry. The total interest on capital is 3,100 lamai. The total. That means what? Out of the 6,480, I have appropriated 3,100 as interest on capital. As interest on capital. Now I have how much? Now I have only 3,380 to appropriate as partners remuneration and the profit shares. Partners remuneration and the profit shares. Now let's see, are there any partners remunerations? Yes, here partner salary is therefore Udit. How much? 44 month. So 44 month into 12 months, it's 480. It's 480. This is the entitlement. This is the profit appropriation. So how to do that? Here partner salary, it is 480. So I am splitting 480 out of the 3,380, and I am crediting that the partner salary. I am crediting that the partner salary to the current account, of whom? Udit. It's entitled by the Udit, not any other one. It's entitled by the Udit. Okay. Done. Okay. Okay. Then the remaining. How much? Remaining we have 2,900 to appropriate as what? Remaining we have 2,900 to appropriate as the profit shares. Now we have this to appropriate as profit shares. How to appropriate as profit shares? Profit share, or else I would put share of profit. How to do that? Now the profit sharing ratio, new one. What was the new one? New profit sharing ratio 433. I have mentioned that here. 433. New profit sharing ratio 433. So very easy, no? Share of profit. How? Share of profit. So Damit will get how much? Out of this 2,900. Okay, I will write that. 2,900, the total one. Out of that, they will get 4%. That means 10 divided by 10 multiplied by 4. 2,900 divided by 10 multiplied by 4 is for Damit. And for Udit, multiplied by 3. And for Meena also multiplied by 3. So you can get 2,900, the total here. Now, when I split that here, so the net balance will be, 0. Okay. Done. The net balance will be 0. Okay. Net balance will be 0. Clear. We are done. We have appropriated the profit. So almost all the information were successfully completed. Now, if you go and look at the process that I told you, first of all, we record the capital introduced, then adjust for the goodwill, then adjust for the revaluation, then the profit entitlement, because this person entered into the organization. Okay, this person entered into the organization at the beginning of the year. Now what we can do is, now we can balance off these accounts. You can peacefully balance off these accounts. Okay, later. You can do that later. Peacefully balance off those accounts. I will also do that for you. Now this is done at the end of the period. This is done at the end of the period. This is done at the end of the period. So balance carried down. Balance carried down. Damit, Udit, and Meena. Meena is the same one. So 1st January 2021, balance brought forward. 1st January 2021, balance brought forward. This one, this figure. Okay, done. It's very easy, no, my dears. It's very easy for us. Done. Okay. Great. Now, we have completed a scenario when a new partner is admitted. Okay. Now we have come to the last part of the session. So in this part, I'm going to teach you how to account when a partner is retiring. Okay. So question number 18, last one. Show the steps to follow in accounting when a partner is retired. Now, you know, my dear students, a partner can retire at the beginning of the year or at the end of the year. Here also the key point is at which moment in the retiring at the beginning of the year or retiring at the end of the year. In which instance we need to appropriate profit. We need to appropriate profit to the said partner. Now, if the partner is retiring at the beginning of the year, do we need to give profit for that period to him? What do you think? No, it's not required. No, why? If he is getting out from the business from the very first day of the financial year, now to earn the profit within that financial year, he was not there. So do we need to give profit without him? No need. No need. Okay, that's the simplest thing. So if the partner retires at the beginning of the year, then we do not need to give the profit or appropriate the profit for that partner. But if he retires at the end of the year, then we must. So let's see. When a partner retired at the end of the year, partner is entitled to the current year profit. Yes, why? He is going at the end. He's going at the end. Then record goodwill and revaluation. Yes, same like previous. We need to record goodwill and revaluation. After recording the goodwill revaluation and the profit appropriation, we need to do one thing. We need to transfer the current account balance to the capital account. This is an important thing. We need to transfer the balance of the current account to the capital account. Usually what will happen? Usually if the balance is in credit side, then we need to debit the current account. Then we need to debit the current account and credit the capital account. Usually this is what happens. Usually this is what happens. So we need to transfer the current account balance to the capital account. Okay. Then I told you when a partner is retiring, we need to give his equity. We need to pay his equity. If we are making a payment, then we need to record that payment, cash credit, capital account debit. Why? The entire entire equity is now in the capital account. We transferred the current account balance also to the capital account. Then finally, in case if an amount is unpaid, that amount need to be transferred to a loan account. Amount is transferred to a loan account. So this process need to be followed, my dears. When it comes to a retirement at the beginning of the year, partner is not entitled to the profit of that year and no need to appropriate profit for that partner. Okay, for that partner. Then need to record goodwill and revaluation, transfer current account balance to the capital account, record any payment. If there is unpaid, then transfer to the loan account. In this point, we need to keep in our mind. Now, when we are transferring the unpaid amount to the loan account, okay, when we are transferring the unpaid amount to the loan account, that if it is mentioned in the partnership agreement, then also we need to pay an interest. But in case if it is not mentioned in the partnership agreement, section 42 says something. What? Can you remember? Section 42 says maximum 5% per annum interest need to be paid. Therefore, this interest need to be recognized, and this should be recognized as an expense when calculating the profit. So when calculating the attributable or appropriatable profit, we need to consider that also as an expense. So please keep that in your mind. That's all. That's all. Now with this understanding, let's go for a question. So this is question number 3 of January 2022. Okay, let me open it in the full paper. Let's read. Rajit, Malit and Udit were in a partnership business under the name of RMU Partners, sharing profits and losses in the ratio of 1:2. So here, Rajit, Malit and Udit, all profit sharing ratio 1:2. Okay, 1:2. The partnership agreement provides the following. Malit is entitled to receive a monthly salary of 35,000. Interest on capital 6% per annum is to be paid on the opening capital account balances. Now, Lamai, this partnership agreement is whose partnership agreement? This is RMU. RMU all. Okay, that tri-party agreement. RMU partnership agreement. Okay. Fine. Now, first of all, let's see the requirement here. Here also they are asking us to prepare for the year ended 31st December 2021, the capital accounts and the current accounts. Okay. So before reading other stuff, we can make sure that we prepare current account and the capital account. So let me show you here 31st December for the year ended. I am preparing partners capital account and the partners current account. Here also let's do this question in rupees thousands. Rupees thousands. Here also in rupees thousands. Okay. Super. Now let's read the question one by one. Partners capital and current account balances as of 1st January 2021 were as follows. Okay. Capital and current account balances are given. Now, since we are doing the question, we can directly record them. So, capital accounts RMU in respectively 366. Okay, 3,000, 6,000, 6,000. Okay, let me record. Capital accounts 1st January 2021 balance brought forward 6,000, 6,000. Sorry, 3,000, 6,000, 6,000. 3,000, 6,000 and 6,000. Okay, done. The capital account balances are recorded. Okay, the capital account balances are recorded. Then the current account balances, you can see Rajit and Udit have 125 and 25 in credit side. Okay, let's record. Rajit and Rajit or Ranjit? Rajit, no, sorry, I have mentioned it as Ranjit, no issue. Here, 125 for Rajit. For Malit, it's, sorry, for Udit, it's 25. For Udit, it's 25. Okay. Done. And for Malit, it is 560 debit. For Malit, it's 560 debit. Okay, let's record that one. For Malit, it's 560 debit. 560 debit. Okay. Done. Recorded. Then, this is okay. On 31st December 2021, Malit decided to retire from the partnership and Rajit and Udit decided to continue the business under the same business name, sharing profit or loss equally. So the new profit sharing ratio, who is going to leave now? Malik decided to. So the retiring partner is in the middle now. This one is retiring. So the new one, Rajit is Ujit equally. Rajit and Udit equally. Okay, good. And most important fact is on which date that they are going. On which date that they are going. On which date? On 31st December 2021. That means year end. This is pretty much important, okay? Year end. So if the partner is retiring at the year end, what we need to do? We need to appropriate the profit for that partner also. Okay, appropriate the profit for that partner also. Great. And let's read. The net profit for the partnership after charging Malik's salary for the year ended 31st December 2021 was 7,000. After charging Malik's salary. What is that, Lamai? Malik's salary, Malik is a partner, no? Here. Can you see? The partnership agreement provides Malik is entitled to receive a monthly salary of 35,000. This is what? This is the partner salary. That's why it is mentioned in the partnership agreement. Okay. If this is a specialized service, then it is not mentioned in the partnership agreement sometimes. Sometimes it can be mentioned, but it will be separately given. They have not mentioned a separate thing. No? Therefore, this is partner salary. Partner salary or partner's remuneration cannot be deducted when calculating the profit. This is a profit appropriation. It is profit appropriation. So, this net profit is wrong. Why? This net profit is wrong because Malik's salary has deducted. We can't do that. We can't do that. Therefore, we need to add it back. We need to add it back. Clear? We need to rectify that. Then the goodwill adjustment and the revaluation adjustment. Finally, it was decided to transfer the amount payable to Malik at his retirement to a loan account. Okay. That's very easy. So first of all, we need to appropriate the profit. To appropriate the profit, we need to rectify the profit. So I will do a working for that. So workings in rupees thousands. Workings in rupees 1,000. So draft profit, I would say draft profit. Draft profit. How much is the draft profit? How much is the draft profit, Lamai? It's 7,000. 7,000. It is wrong. That 7,000 is wrong. Okay. So we need to add back what? We need to add back the partner salary. Add back the partner salary. We need to add back the partner salary. Okay. So how to add back the partner salary? How to add back the partner salary? Let's check. Let's check. Monthly how much? Monthly 35. So 35 into 12. 35 into 12. How much? It is 420. It is 420. Okay. So 35 into 12. It's 120. 420. Sorry. 420. So the correct profit is 7,420. Correct profit. Or adjusted profit. Correct profit. Okay. This correct profit need to be, okay. This correct profit need to be again appropriated. Again appropriated. How to do that? How to do that? So profit appropriation. Now I am recording this. This as a profit appropriation we need to record now. So how to record that? This 420 need to be credited to the what? It is credited to the Malik's current account. Okay. So here partner remuneration. Partner remuneration, it's 420. It's 420. So this adjustment is not required actually. The net impact will be 0. But for your better understanding, I am doing this. Okay. 420. So here partners remuneration. Partners remuneration for Malik is 420. For Malik, it's 420. Then, sorry. Then what is the balance figure? we have 7,000. Remaining 7,000. Okay. We have remaining 7,000 to disburse or appropriate. So for that, we need to give what? For that, we need to give the interest on capital. We need to give interest on capital. How to calculate the interest on capital? They say 6% per annum on the opening capital account balances. Okay. This is the opening capital account balances, 6%. So interest on capital, interest on capital. So how we are crediting the partner's current account? The balance 3,000 into 6%. So 180, 6,000 into 6%, 360. Again, 6,000 into 6%, 360. So altogether, if you check, it is 720. Here, it is 720 total interest on capital. That means out of the profit 7,000, we appropriate 900 as interest on capital. Therefore, my dear students, we have 6,100 rupees. 6,100 rupees to distribute as what? To distribute as share of profits. Share of profits. Now you know how to distribute share of profits. So R or Rajit, Malit, and Udit. How to distribute with them? How to distribute with them? Now you know. Based on their profit sharing ratio. Now we need to give a profit share to Udit also, Malit and Udit both. Okay, that means all three. All three. So all three profit share can be given using old one. Old profit sharing ratio. Okay, otherwise in the new one, nothing allocated to Malit. Therefore, we need to allocate, we need to appropriate the profit. Okay, we need to appropriate the profit using the old profit sharing ratio. So 1, 2, 2. Okay, 1, 2, 2. That means 5. Altogether 5. So how to do that? 6,000 divided by 5 multiplied by 1. Multiplied by 1 for Rajit. Then 6,000 divided by 5 multiplied by 2 for Malit, and the same for Udit also. Same for Udit also. So the answer will be here. So the answer will be 0. So the answer will be 0. Okay. 2 to 1. That's the ratio. 2 to 1. So here 6,100 divided by 5, and here 6,100 divided by 5 into 2. Okay, that's how it goes. So share of profit. Share of profit 1,220, 2,440, 2,440, 2,440. Okay, that's how it goes. Done. Now we have appropriated the profit. We have appropriated the profit. Then what we need to do? Then we need to adjust for the goodwill. Okay. Then we need to adjust for the goodwill. Let's do that goodwill adjustment. Goodwill adjustment. So on 31st December 2021, goodwill of the partnership, that means the total goodwill, was valued at 1,750. It was agreed to adjust through capital account. So how to adjust? Debit to capital accounts, new ratio. Credit to capital accounts, old ratio. Credit to capital accounts, old ratio. Okay. So here, debit to capital account, goodwill at new ratio. So in new ratio, there is only Ranjit and Udit. Only Ranjit and Udit. Are you clear? Here, only Ranjit and Udit. Here, Ranjit and Udit. Or Rajit and Ujit. Okay. So equally 1 to 1. So our total amount is how much? 1,750. 1 to 1 means equally 50-50. So divided by 2. And the same amount will be given to Udit. Okay. So debited to Rajit and Udit. Same amount. 875, 875. The new ratio at new ratio. Then goodwill. Goodwill at old ratio. Old ratio, how? 1, 2, 2. 1, 2, 2. So how to do that? 1,750 divided by 5 multiplied by 1 for Rajit. Okay. 1. Then 2, 2. How? 1750 divided by 5 into 2. Simply the double of this one. And 4 is also the same. Now, if you see, the total is 1750. Done. Goodwill adjustment done. How to do? Debit to partners capital accounts at new ratio, new profit sharing ratio. Credit at all profit sharing ratio. Done. Then we need to adjust for the revaluation. I will not work it out in the Excel. I will simply tell you how to do that here. Now you can see the revalued amount is 8,000 here. Cost is 8,000 and accumulated depreciation is 1,500. So the revalued amount and carrying amount is the things that we need to compare. No? Here the revalued amount is 8,000 and the carrying amount is here 8,000 less 1,500, that is 6,500. So here we have a gain of what? From this asset we have a gain of 1,500. Here 1,500 gain. 1,500 gain. And for motor vehicles, you can see revalued amount is 7,500 and the carrying amount is 2,000 just here. 5,000 less 3,000. So here you can see there's a gain of 5,500. Wow, what a massive gain. Massive gain. So there's a gain of 5,500. So altogether, the total gain is how much? The total revaluation gain, 1,500 plus 5,500, it is 7,000. It is 7,000. Total gain, 7,000. This total gain need to be distributed using old ratio. What is the old ratio? 1 to 2. Okay. 7,000 need to be split using that old profit sharing ratio. 1 to 2. So let me do revaluation. So this is a gain, net gain. Gain is an increase in the equity. So I am crediting to capital accounts. 7,000 divided by 5, 400. Okay. Then 7,000 divided by 5 into 2. Into 2 for Malit and for the also the same. So if you see this total, the total splitted is 7,000. That is our net gain. That net gain is splitted using old profit sharing ratio. Old profit sharing ratio. Okay. Done. Now we recorded the revaluation. We recorded the goodwill. Done. Done. Okay. Our next step is what? Next step is to what? Our next step is to transfer the current account balance of Malit to the capital account. Now, first of all, let's do that before going for others. Okay. First of all, let's transfer. First of all, let's transfer the current account balance of Malit. Let's transfer the current account balance of Malit. Here, Malit. 3,220. 3,220. So Malit's balance, we need to transfer to the capital account. The balance will come here. No? The balance is how much? The balance is 2,660. We need to transfer it to the capital account. Here, how it is done? Capital account. And then I am crediting that to the capital account here. It's coming from where? It's coming from current account for Malit. This is how the transfer is done. Transferring from one account to another. Transferring from one account to another. Done. Then if we pay in cash, then we need to credit cash and debit to capital account. But here, nothing is going to pay in cash. Therefore, they have mentioned it was decided to transfer the amount payable to Malit at his retirement to a loan account. So the entire amount will be transferred to a loan account. So here, now I am balancing off the Malit's account. I am balancing off Malit's account. 12,160. This entire 12,160 will be transferred to a Malit loan account. Loan account Malit in his name. Loan account Malit. So we will put it like this. Loan account Malit. Okay. Done. That's all. That's all. Now you can balance off the other ledger accounts. Now you can balance off the other ledger accounts. So here. Okay. So balance carried down at 31st December 2021. Balance carried down BCD. So 4,750 less 875 is 3,875. Here it is 0. Malit's capital account will not continue. It will be 0. It will be 0. And Udit's will be 8,625. So 1st January 2022 balance brought forward 3,875. For Malit it is 0. Okay. For Udit it is 8,625. Just telling off the accounts. Just telling off the accounts. Then with regard to the current accounts, we need to balance off the current accounts of Ranjit and Udit also. Ranjit and Udit also. Okay. So these accounts will be like this. So balance carried down 31st December 2021 here. It is 1,525. And for Malit's, can there be a balance for the current account? No. When you tally account, it will be 0. It will be 0. Why? He is retired now. Nothing to carry forward. He is out of the business. He's out of the business. Okay. So with regard to the with regard to the current accounts, the opening balances for the next year will also be same as the closing of current year. Now, my dear students, it's very easy. Okay, it's very easy if you follow the method that I taught you. So we did a question on that also. Done. Okay. So this marks the end of the session that was focusing on your examination. So I believe with this session, you got an idea, whole or a holistic idea with regard to the partnership accounting. And here I discussed the entire aspect. And even though I said this as a exam focus revision one, it can be also considered as a theory one also. I covered the entire theory aspects. Okay, so I wish you all the very best for your upcoming exam. If you have any doubts, you can contact me. I have mentioned the number in the videos also. So, and even you can contact me through AAT. So once again, thank you very much for the Association of Accounting Technicians of Sri Lanka giving me the opportunity to conduct a session for you. So thank you. All the best for your exams.